Types of capital gains and losses. In Canada, capital gains and losses are categorized by the type of capital property sold, such as personal use property, listed personal property, LPP, depreciable property, qualified small business corporation shares, QSBCS, and qualified farm or fishing property, QFFP. A capital gain occurs when you sell an asset for more than its adjusted cost base, ACB, while a capital loss happens when you sell it for less. Generally, 50% of a capital gain is taxable, and allowable capital losses can be used to offset taxable capital gains. Here are some common capital gains and losses with examples. Personal use property, what it is. Property you own primarily for personal enjoyment like a car, boat, or furniture. Gains are taxable, but losses are not deductible. The Canada Revenue Agency, CRA, uses a $1,000 rule, where if the adjusted cost base is less than $1,000, it is deemed to be $1,000. Example, gain. You buy a cottage for $200,000 and sell it for $300,000. This is a capital gain of $100,000, which is taxable. However, the sale of your principal residence is exempt from capital gains tax. Example, loss. You buy a boat for $15,000 and sell it for $10,000. The $5,000 capital loss is not deductible. Listed personal property, LPP. What it is. A type of personal use property that is likely to increase in value, including items such as rare coins, stamps, art, and jewelry. How it works. Gains are taxable and losses are deductible, but only against gains from other LPP. Losses can be carried back 3 years and forward 7 years. Example, gain. You buy a rare stamp collection for $5,000 and sell it for $8,000. Your capital gain is $3,000, and 50% of this gain, $500, is taxable. Example, loss. You sell a piece of jewelry for a $2,000 loss. You can only use this loss to offset gains from other LPP. 3. Depreciable property and recapture. What it is. Capital property used to earn income, like business equipment or a rental building for which you can claim a capital cost allowance, CCA. How it works. When you sell a depreciable property for more than its undepreciated capital cost, UCC, but less than its original cost, the CCA you claimed is recaptured and added to your income for the year. A capital loss is not possible on the sale of depreciable property. Example, recapture. You own a rental property and claim $10,000 in CCA on the building. You later sell the property. The proceeds are more than the building's UCC. The $10,000 in CCA you previously claimed must be included in your income. Example, terminal loss. You sell all assets in a depreciable property class for less than the UCC. You can deduct the remaining balance as a terminal loss against your business income. Qualified small business corporation shares, QSBCS, and qualified farm or fishing property, QFFP. What it is. Shares of Canadian-controlled private corporations, QSBCS, or certain farm fishing property, QFFP, that may be eligible for a lifetime capital gains exemption, LCGE. Example, you sell your qualified farm property for a capital gain. You may be able to use your LCGE to reduce or eliminate the taxable portion of the gain, subject to certain conditions. 5. On other capital properties investments. Gains and losses from stocks, bonds, mutual funds, and ETFs are considered capital gains and losses. Example, gain. You buy $1,000 of stock and sell it for $1,500. Your capital gain is $500 and $250 is taxable. Example, loss. You sell stock for a $500 loss. This can be used to offset other capital gains. Real estate, non-principal residence. Sales of cottages, investment properties, and land are subject to capital gains tax. Other dispositions. Capital gains can also result from deemed dispositions, such as giving a capital property as a gift, converting securities, or exchanging one property for another. Like our contents, hit follow, like, share, and subscribe. Thanks for watching.